You know, I've been investing for over 8 decades now. I've seen the Great Depression's aftermath, the stagflation of the 70s, Black Monday in 87, the dot-com bubble, and yes, the catastrophe of 2008. And I'm going to tell you something today that might keep you up at night, but it needs to be said. What's coming could make 2008 look like a warm-up act. Now, I'm not one for hyperbole. Charlie Munger used to joke that I'm about as exciting as watching paint dry. But when I see what I'm seeing in the markets today, the leverage, the speculation, the complete abandonment of basic investing principles, I can't stay quiet. In 2008, we had a housing crisis that nearly broke the global financial system. Today, we've got that same disease, but it's infected every organ of the economic body. The warning signs are flashing red. Central banks have painted themselves into a corner. Corporate debt is at levels that would have been unthinkable a generation ago. And everyday investors, good people just trying to secure their retirement, are being led like lambs to slaughter. So let me tell you what I see coming, and more importantly, how you can protect yourself. Let me start with a principle I've followed my entire life. Be fearful when others are greedy, and greedy when others are fearful. Right now, we're living in the most extreme period of greed I've witnessed since the late 1990s, and we all know how that ended. But this is different. This is worse. In 2008, the problem was concentrated primarily in housing and the financial derivatives tied to mortgages. The disease had a specific location. You could identify it, isolate it, and eventually treat it, though the treatment was painful and cost taxpayers trillions of dollars. Today, the disease is systemic. It's everywhere. Let me walk you through what I'm seeing, piece by piece. First, let's talk about debt. I've always said that debt is like oxygen, useful in moderation, deadly in excess. Global debt has exploded to over $350 trillion. That's not a typo. 350 trillion. That's roughly 4 times the entire world's GDP. Corporate debt in the United States alone has doubled since 2008, reaching nearly $11 trillion. Now, debt itself isn't necessarily bad. Berkshire Hathaway uses debt strategically. But here's the problem. Much of this debt was accumulated when interest rates were essentially zero. Companies borrowed money not to invest in productive capacity or innovation, but to buy back their own stock and pump up share prices. They took on debt to pay dividends they couldn't afford from actual earnings. What happens when interest rates normalize? And let me be clear, by normalize, I don't mean return to 1980s levels of 15 or 20%. I mean just getting back to historical averages of 4 to 6%. These companies will face an interest expense burden they simply cannot service from their operating income. I'll give you a specific example without naming names. There are dozens of so-called zombie companies, firms that earn just enough to pay the interest on their debt, but nothing more. They don't grow. They don't invest, they just exist. When rates were near zero, they could stumble along. Now, they're the walking dead, and the debt collectors are coming. Second, let's discuss the everything bubble. In my early years, we had the Nifty 50 bubble in the early 70s. 50 stocks that were bid up to ridiculous valuations because they were seen as one-decision stocks you'd never need to sell. That ended badly. Then we had the dot-com bubble, where companies with no earnings and barely any revenue were valued in the billions. That ended even worse. Today, we don't have a bubble in one sector. We have bubbles everywhere simultaneously. Stocks are expensive by almost every historical measure. Price-to-earnings ratios, price-to-book, cyclically adjusted valuations. Bonds are expensive, with yields that don't compensate for inflation risk. Real estate in major cities has been bid up to levels where average families cannot possibly afford homes. Cryptocurrencies, well, I've made my views on those clear over the years. When everything is expensive at once, there's nowhere to hide when the correction comes. Third, and this concerns me greatly, is the complete abandonment of investing principles among a new generation of market participants. I learned to invest by reading Benjamin Graham's The Intelligent Investor. The core principle was simple: buy a dollar's worth of value for 50 cents and be patient. Today, I see people investing, and I use that term loosely, based on social media posts, memes, and the fear of missing out. They're not analyzing cash flows, competitive advantages, or management quality. They're gambling, pure and simple. And when you have millions of people gambling with money they can't afford to lose, often borrowed money or money meant for retirement, you've created a powder keg. The financial media hasn't helped. They've turned investing into entertainment, with countdown clocks and breathless commentary about every tick in the market. They've created an environment where people think they need to trade constantly, racking up fees and taxes, instead of buying quality businesses and holding them. Fourth, let me address the role of central banks. I have tremendous respect for the Federal Reserve and other central banks. They're staffed by smart, dedicated people trying to do an impossible job. But I think they made a critical error after 2008. Instead of allowing a real cleansing of the system, yes, it would have been painful, they papered over the problems with unprecedented monetary stimulus. They bought trillions in bonds, drove interest rates to zero and even negative in some countries, and essentially told the markets that they'd always be there as a backstop. This created what's called moral hazard. Why should investors exercise caution and discipline when they believe the Fed will always ride to the rescue? Why should companies maintain conservative balance sheets when money is free? The Fed created a generation of investors who've never experienced a real bear market, never seen what happens when the punch bowl is taken away. Now, the Fed finds itself in an impossible position. Inflation has forced them to raise rates, something they should have done years ago, but they can't raise them too much or too fast without triggering the very crisis they're trying to prevent. They're trying to thread a needle while riding a bicycle on a tightrope over a canyon in the dark. Let me tell you what keeps me up at night more than anything else: the interconnectedness of today's financial system. In my grandfather's day, if a bank in Kansas failed, it was a local problem. Maybe it affected the surrounding counties. Today, if a major bank anywhere in the world gets into trouble, the contagion spreads globally within hours, sometimes minutes. We saw this in 2008 with Lehman Brothers. One investment bank's failure nearly brought down the entire global financial system. Why? Because every major financial institution was connected to every other through a web of derivatives, repurchase agreements, and counterparty relationships so complex that nobody, and I mean nobody, fully understood the total exposure. Has that changed since 2008? Sure. We've got the Dodd-Frank Act and stress tests and higher capital requirements. But the system is even more interconnected now than it was then. The derivatives market is larger. The too big to fail banks are bigger. And we've added new sources of systemic risk that didn't exist in 2008. Take the rise of passive investing and index funds. Now, I'm not against index funds. In fact, I've recommended them for most individual investors in my annual letters. But when trillions of dollars flow into passive strategies that buy everything in an index, regardless of price or value, you create distortions. You have stocks being bought simply because they're in an index, not because anyone analyzed whether they're worth owning. What happens when that flow reverses? When people start pulling money out of these funds, the selling will be indiscriminate, just like the buying was. Good companies will get hammered along with bad ones. Then there's the shadow banking system, the complex world of hedge funds, private equity firms, and other non-bank lenders that operate outside traditional regulatory frameworks. These entities now control trillions in assets and play a crucial role in credit markets. But unlike traditional banks, they're not subject to the same oversight, capital requirements, or stress tests. In a crisis, who bails them out? What happens to the companies and individuals who depend on them for credit? Let me talk about something else that troubles me: the geopolitical situation. Markets don't operate in a vacuum. They depend on stability, predictable rules, and open trade. Right now, we're seeing the most significant deterioration in international relations since the Cold War. The relationship between the United States and China, the world's two largest economies, has fundamentally changed. We're no longer just economic partners with occasional disagreements. We're strategic competitors, and increasingly, that competition is turning adversarial. Supply chains that took decades to build are being reconsidered and restructured. The free flow of goods, services, capital, and technology that powered global growth for the past 30 years is being questioned. I've always believed in free trade and open markets. When countries trade with each other, they have incentives to maintain peaceful relations. When those economic ties are severed, history shows us what can happen, and it's rarely good for markets or humanity. Add to this the situation in Europe with the ongoing conflicts, the instability in the Middle East, and the general rise of populist movements that question the post-World War II international order, and you have a recipe for increased volatility and risk. Now, let me address something that many younger investors have never experienced: a real recession combined with a bear market. Since 2009, we've had the longest bull market in history. An entire generation of investors has only known rising prices. They've been conditioned to buy the dip because every dip has been a buying opportunity. But that's not how markets normally work. Real bear markets, the kind that cuts stock prices in half or more, test your conviction, your discipline, and your stomach in ways you can't imagine until you've lived through one. I've seen grown men cry watching their life savings evaporate. I've seen panic selling at the worst possible moment. I've seen people swear they'll never invest in stocks again. In 2008 to 2009, the S&P 500 fell 57% from peak to trough. The decline lasted about 17 months. If you had $1 million invested, you watched it become $430,000. Could you have held on? Most people couldn't. They sold near the bottom, locked in their losses, and missed the subsequent recovery. And here's what worries me. This time, the fall could be steeper and the recovery slower. Why? Because the traditional tools we use to fight recessions and market crashes are largely exhausted. In previous downturns, central banks would slash interest rates and governments would increase spending. Those tools worked, they cushioned the blow and helped economies recover. But interest rates are already low by historical standards, and government debt levels are so high that there's limited room for massive new stimulus programs without triggering concerns about sovereign debt crises. Japan has been trying to stimulate its economy for 3 decades with limited success, despite interest rates at zero and massive government spending. Europe has struggled with low growth for years despite aggressive monetary policy. What makes us think the same tools will work better this time? I want to talk about the commercial real estate situation because it's not getting the attention it deserves. During the pandemic, working patterns changed fundamentally. Millions of people discovered they could work from home effectively. Even as pandemic restrictions ended, many companies maintained hybrid or remote work policies. The result? Office buildings in major cities are sitting half empty or worse. I'm seeing reports of office vacancy rates in some cities reaching 25 to 30%. These buildings were financed with debt based on the assumption of steady rental income. When tenants don't renew leases or demand lower rents because they need less space, the math stops working. Who owns this debt? Banks, particularly regional and community banks, insurance companies, pension funds. When these loans start defaulting, and the losses will ripple through the financial system in ways we're only beginning to understand. This isn't just a problem in the United States. China, which has been the engine of global growth for 2 decades, is facing its own real estate crisis that makes our commercial real estate challenges look small by comparison. Their residential property sector, which represents roughly a quarter of their entire economy, is in serious trouble. Major developers have defaulted on billions in debt. Millions of apartments that people paid for haven't been completed. The social and economic implications are staggering. When China sneezes, the world catches a cold. And right now, China isn't just sneezing, it's showing symptoms of something far more serious. Now, I know what some of you are thinking. Warren, you've been warning about overvaluation for years, and the market kept going up. Maybe you're just getting old and out of touch. Fair point. Let me address it directly. It's absolutely true that markets can remain irrational longer than you can remain solvent, as the saying goes. I've been cautious about overall market valuations since 2017, and yes, the market has gone up since then. People who ignored my caution and stayed fully invested made money, on paper at least. But here's what I've learned in 8 decades of investing. You can be early, but you shouldn't be wrong. Being cautious when markets are expensive might mean you underperform in the short term, but it also means you have capital to deploy when the inevitable correction comes. And more importantly, it means you can sleep at night. At Berkshire Hathaway, we're sitting on over $150 billion in cash and short-term treasury bills. People criticize me for this constantly. You're missing out on returns, they say. You should be deploying that capital. But I didn't accumulate this cash because I thought I was smarter than the market. I accumulated it because I couldn't find investments that met my criteria for value and safety at prices I was willing to pay. When everything is expensive, the best move is often to do nothing, to wait for opportunities. And when the crisis comes, not if, but when, we'll be ready. We'll have the cash to buy wonderful businesses at fair prices, or better yet, fair businesses at wonderful prices. That's how we built Berkshire Hathaway. Not by being the smartest or the fastest, but by being patient and disciplined. So what should you do? Let me give you some practical advice based on principles that have worked for nearly a century. First, understand your own psychology. The biggest investment risk isn't market volatility, it's your own behavior. If you can't handle watching your portfolio drop 30, 40, or 50% without panic selling, then you shouldn't be fully invested in stocks regardless of market conditions. Know yourself. Be honest about your risk tolerance. Second, maintain liquidity. In good times, cash seems like a waste. It earns almost nothing and loses value to inflation. But in bad times, cash is oxygen. It gives you options. It lets you sleep at night. It allows you to take advantage of opportunities when they arise. I recommend that most people keep at least 6 months of living expenses in cash or cash equivalents, maybe more if you're retired or have an unstable job situation. Yes, you'll lose money to inflation in the short term, but you'll have security and flexibility when it matters most. Third, if you own stocks, focus on quality. Not every company will survive the coming crisis. Look for businesses with strong balance sheets, low debt, consistent profitability, and competitive advantages that aren't dependent on easy credit or consumer speculation. Ask yourself, will people still need this company's products or services in a recession? Can this company survive if credit markets freeze up? Does management have a track record of navigating difficult times? The companies that fit these criteria might not be the most exciting growth stocks, but they're the ones most likely to survive and thrive on the other side of the crisis. Fourth, avoid debt in your personal life. I cannot stress this enough. Leverage amplifies gains in good times but destroys wealth in bad times. If you're carrying credit card debt, car loans beyond what you absolutely need, or a mortgage that stretches your budget, you're vulnerable. In a crisis, people lose jobs, businesses fail, investment portfolios decline. If you're over-leveraged when this happens, you can lose everything: your home, your savings, your peace of mind. Pay down debt now while you can. Create a cushion. Financial security isn't about how much you make, it's about the gap between what you make and what you spend. Fifth, diversify sensibly, but don't over-diversify. Some people think diversification means owning hundreds of stocks across dozens of sectors and countries. That's not diversification, that's lack of conviction. You can't possibly understand that many businesses well enough to know what you own. I'd rather own stakes in 5 or 10 wonderful businesses that I understand thoroughly than own 100 businesses I know nothing about. Quality over quantity, always. That said, don't put all your eggs in one basket either. Even the best businesses can face unexpected challenges. Spread your risk, but do it thoughtfully. Sixth, and this might surprise you, don't try to time the market perfectly. I can't tell you whether this crisis will start next month, next year, or 3 years from now. Nobody can. The signs are there, the risks are real, but timing is nearly impossible. What I can tell you is this: position yourself so that you can survive and even prosper regardless of what happens. If the market keeps going up, you'll participate in those gains, even if not fully. If the market crashes, you'll have the resilience and resources to weather the storm and take advantage of opportunities. This isn't about being the hero who perfectly times the top and bottom. It's about being the tortoise who keeps moving forward steadily while the hares exhaust themselves. Let me share something personal. In my career, I've made plenty of mistakes. I've bought companies I shouldn't have. I've missed opportunities I should have taken. But the mistakes that hurt the most weren't the bad investments. Those are part of the game. The mistakes that hurt were when I violated my own principles out of fear or greed. When I bought stocks, I didn't understand because everyone else was making money. When I held on to losers too long because I couldn't admit I was wrong. When I got swept up in the excitement and forgot the fundamentals. Don't make those mistakes. Stick to your principles, especially when everyone around you is abandoning theirs. Now, I want to end on a note that might seem contradictory to everything I've said. I'm optimistic about the long-term future. Yes, a crisis is coming. Yes, it will be painful. Yes, many people will lose money they can't afford to lose. But crises are also opportunities. They're how the economic system cleanses itself, how resources get reallocated from unproductive uses to productive ones, how new innovations and businesses emerge. America has faced existential challenges before: the Great Depression, World War II, the Cold War, the 2008 financial crisis. Each time, people predicted the end. Each time, we adapted, recovered, and came back stronger. The same will happen this time. The question isn't whether we'll get through this, we will. The question is how you personally will navigate it. Will you panic and make emotional decisions that lock in losses, or will you stay disciplined, follow sound principles, and position yourself to emerge stronger on the other side? I've been investing through crisis after crisis for 8 decades. The pattern is always the same: fear, capitulation, and eventually recovery and renewal. The investors who do well aren't the ones who avoid the crises. Nobody can. They're the ones who prepare for them, maintain their composure during them, and have the courage to act when others are paralyzed by fear. So, yes, be concerned, be cautious, be prepared, but don't be paralyzed. Don't abandon the stock market entirely or stuff your money under a mattress. Just be smart, be patient, and remember that your greatest asset isn't your portfolio. It's your ability to make rational decisions when everyone around you is losing their heads. The storm is coming, but storms always pass. And on the other side, there will be opportunities for those who kept their powder dry and their wits about them. That's what I'm doing at Berkshire. That's what I recommend you do too. Stay rational, stay disciplined, and whatever happens, don't bet against America or against yourself over the long term.